Introduction of options. The size of option market and the importance of options. The size of option market is far smaller than futures market. However, as a non-linear derivative product, its theoretical significance is far greater than other linear products. Many other derivative securities, such as credit default swaps, are really options. All real investments are nonlinear. Initially, one invests a lot on fixed costs, with little payoff. Later, one invests very little, but with large payoff. Education is such an example. During time of education, one pays a lot with little payoff. After graduation, one reaps the benefits of education. Broad applications. The concept of option has very broad applications. Insurance are put options. Equities are options. Debt are options. With option theory, Japan can be extended to debt market seamlessly. Project investments are understood as real options. There are two types of options. A call option is an option to buy a certain asset by a certain date for a certain price. This price is called strike price. A put option is an option to sell a certain asset by a certain day for a certain price. There are different types of options. A European option can be exercised only at the end of its life. An American option can be exercised at any time before the contract expires. There are many other types of options, like cooperation option or Asian option. Different options have different definitions. There are a lot of specifications of options. First is expiration date, when the contract expires. Second, its strike price, at what price an asset is bought or sold. Whether it's a European or an American, or it's a call option or put option. A call option is the right to buy an asset. A put option is the right to sell a certain option at a certain price. A long call or a Microsoft share. Long means buy. So when the profit from buying a European call option on Microsoft share, say the option price is $5 and strike price is $60. So when you buy this call option at $5, you start to get payoff when the share price is over $60. When the share price reach $65, you break even. If share price get higher, you earn a profit. But if the share price is lower than 60 when the contract expired, you do not get any payoff. Short call on Microsoft shares. Short is sell. So you sell a call option on Microsoft. Again, the option price is $5 and the strike price is $60. You see, if the share price at the end of the contract remain below $60. You pocket $5 premium from selling this option. But if the share price becomes higher than 60, you have to pay the option buyer a certain amount. The higher the share price, the more you have to pay. Here is the payoff structure for a long put on IBM. So here, the option price is $7 and the strike price is $90. So you buy this put option for $7. If the share price remains above $90 when the contract expires, the option expires worthless. But if the share price is lower than 90, you get a payoff. The lower the share price, the more payoff you will get. This is put option. Here is short put on IBM. Short is seller. So in the previous slide is a buyer of this put option, and here it is a seller of the put option. So the option price again is $7. So you earn $7 premium on selling this put. When the share price remains above $9 when the contract expires, you pocket this $7 premium. But if the share price drops below 90, you have to start to pay out. When the share price drops to 83, you break even. If the share price drops more, you start to lose money. So here these four pictures are the payoff diagram of the first one is long call. The top at the right is short call. And bottom left is long put. And bottom right is short put. Observation. The graph of the payoff structure of long call is identical to energy of electrons in photoelectric effect. In 1905, Einstein wrote a paper on photoelectric effect, for which he won a Nobel Prize in Physics at 1921. He proposed that photoelectric effect is a quantum effect. The mathematical method we use to find option prices is similar to a method in quantum mechanics developed by Richard Feynman. The method is called path integral. Particles can move along different paths with different probabilities. Similarly, stock prices can move along different paths with different probabilities. There's some more terminology. Moneyness, at the money option, in the money option, and out the money option. At the money option is that the price of the option is same as the strike price of option. And in the money option is that at that price, if you exercise the option, you can make money. When out of money option, when you exercise option, you cannot make any money. It's called out of the money option. Of course, we will not exercise an out of the money option. More terminologies. There are a lot of terminology in option theory. Intrinsic value. Intrinsic value is the option value realized if you exercise the option immediately. Time value. Time value is the option value over level of intrinsic value. Now let's go over an example. Suppose the spot price of a stock is $53. The strike price of the option is $50. The call option price is $5. The intrinsic value is the spot value minus strike value, which is 53 minus 50 equal to 3. Time value is the call option price minus the intrinsic value, which is 5 minus 3 equal to 2. Example 1. A trader buys a call option with a strike price of 50. Here is the graph of the solution. The cost of call option is $3 and put option is $4. Together, the total cost is $7. When the asset price is between 40 to 45, the investor will lose all his $7. And when the share price becomes lower than 40, he will get a payoff from the put option. And you can see the share price getting lower and lower, the payoff will be higher and higher. And similarly, when the share price is higher than $45, he will get payoff from the call option. And as share price becomes higher and higher than $45, his profit will become higher and higher. For detailed Excel calculations and graphs, please check the following file and look at the worksheet example 1. Example 2. A trader buys a call option with a strike price of $35 and a put option with a strike price of $30. Both options have the same maturity. The call costs $3 and the put costs $2. If the share price becomes $42 when option matures, what is the profit loss of this investment? If the share price becomes $25 when options mature, what is the profit loss of this investment? Solution. Call option strike price $35. Put option strike price $30. Call option price $3. Put option price. If the share price becomes $42 when option matures, invest profit loss is 42 minus 35 minus 3 plus 2, which is equal to $2. If the share price becomes $25 when the option matures, investor profit loss is 30 minus 25 minus 3 plus 2 equal to $0. Example 2. In this example, we'll look at the final result of two investors who buy stocks and call options on stocks respectively. Suppose two investors are bullish about company stocks. Each has $100,000 to invest. Current price of the company is $45 per share. The first investor used all her money to buy shares. The second investor buy call options on stocks with strike price at $47. Suppose the option, which will mature in 6 months, cost $3 per share. If share price ends up 48 or $53 respectively after 6 months, what is the final wealth of each investor? For simplicity, we assume one can buy a fraction number of shares and option contracts. Excel calculations. For detailed calculations, please refer to the Excel file and look at worksheet example 2. Here is the summary. When the final price of the share is 48, the first investor who buys the shares will have a little bit over $100,000, paying a little bit because when she bought the shares, it was $47. Now it is $48. For the option buyer, she has only $33,000, lose a lot of money because the final price is only $1 over the strike price. When the final price is 53, for the first investor, her portfolio improved a little bit, but for the second one, her final wealth is $200,000. It doubles her initial wealth because options offer huge leverage. Here is the graph of final value of stock and option. You can see here that the slope of stock is quite gentle, right? Quite small. The slope of option wealth is quite steep, from 0 to over 200,000, and very, very steep when the share price only moves a little bit. Executive stock options. Executive stock options are options issued by a company to its own executives. The purpose is to motivate management to do well for the company. When the option is exercised, the company issues more stocks. This means the new issuance dilute the original stock ownership. They are usually issued at money. They cannot be sold. They often last as long as 10 or 15 years, so they last very, very long. So these options are issued to align incentive of the executives to the general shareholders, but they don't always achieve this goal. So very often, the management will repurchase stocks so to push up the share price over short term, and so they will forfeit investing in projects with long-term value. Sometimes they repurchase too much stocks and the cash reserve become lower than it should be. There is no perfect substitute. Employee options. Startup or young company often issue employee options. If companies do well, early employees can become very wealthy. It is a very effective way to stimulate employees. Bill Gates attributes the rapid growth of Microsoft in great part to its employee option program. Do employee options have similar effect for large and mature companies? Example 4. The asset values of company A and B are both at $2,000 million. Each company is purely financed with equity, with 100 million shares outstanding. The stock prices of company AB are both at $20 per share. Both companies hire new CEOs for a term of 5 years. Company A pays its CEO 1 million shares. Company B pays its CEO call options on 5 million shares with strike price at $20 and a maturity of 5 years. The shares in both cases are new shares issued by the companies. After 5 years, both companies' asset value become $3,000 million. Please calculate the share price of company A and B. Assuming share prices are accurate representation of asset value, what are the values of each CEO's compensation package at the end of year 5? Solution. For company A, the total number of shares is 100 plus 1, which is equal to 101 million. Share price is 3,000 million assets divided by 101 million share, equal to $29.7. The value of CEO's share is $29.7 million because he has 1 million share. For company B, the total number of shares is 100 million plus 5 million equal to 105 million. The 5 million is issued for the options. Share price is 3,000 million plus 5 million times $20. That's the cash from the issuing of these options divided by 105 million shares equal to $29.52. The value of CEO's compensation package is 29.52 minus 20 times 5 million, which is $47.62 million. Discussion. In this case, the shareholders are better off with company A's CEO package. When companies do well, options often dilute more. Options may stimulate managers to adopt highly leveraged strategies that tend to do extremely well or extremely bad. Asset financing. Asset could be financed purely with equity or with mixture of equity and bond. We will investigate how financing methods impact returns. Example 5. A company has 4,000 million asset. 1,000 million is financed with equity. 3,000 million is financed with zero coupon bond with duration of 10 years and annual interest of 5%. If annual asset return is 10%, 5%, and 0%, what is the annual return for equity investors? Solution. The required bond payment at maturity is 3,000 times 1 plus 5% power of 10, which is equal to $4,886 million. The following is scenario of asset increase, say 10%, 5%, or 0% per year. The asset value at maturity are 10,000 million, 6,000 million, and 4,000 million, respectively. The assets belong to equity holders are the total asset minus the asset payment to the bondholders. So you can see that the asset belong to equity holders when the return is 0. Then the asset belong to equity holder is 0 because the total amount of asset, which is $4,000 million, is less than the amount paid to bondholders, which is $4,886 million. So the leftover for equity holder is 0. And annual return for equity holders are 19%, 5%, or negative 100%. So when asset return is 0%, return for equity is negative 100%. When the asset return is 5%, the return for equity holder is 5%. And that's very natural because the bond payment is 5%, asset return is 5%, so the leftover for equity must be 5%. And when the asset return is 10%, the return for equity holder is 19%. Discussion. Without bond financing, the return for equity is the same as the return for asset. With bond financing, good and bad performance are magnified or leveraged. Notice that with high leverage, equity investors could lose all their investment easily. Equity can be understood as call option on asset, with bond payment as strike price. This is an example. The concept of call option can be broadened. Warrants. Warrants are options that are issued or written by a corporation or financial institution. They usually have long-term maturity. Warrants are traded in the same way as stocks. The issuer settles up with the holder when a warrant is exercised. When call warrants are issued by a corporation on its own stock, exercise will lead to new stocks being issued. Financial institutions often issue large amounts of warrants in bull markets to meet investment demand. They often buy back these warrants in bear markets as a service to buy-side professionals. Convertible bonds. Convertible bonds are regular bonds that can be exchanged for equity at certain times in the future according to a predetermined exchange ratio. Very often, a convertible bond is callable. The call provision is a way in which the issuer can force conversion at a time earlier than the holder might otherwise choose. In 1999, Amazon issued $1.25 billion convertible bond, the largest U.S. offering ever. The details can be found from Wall Street Journal article. The cash enabled Amazon to continue its operation with loss. This set high entry barrier to potential rivals. The reasons for convertible bonds. The value of an asset is affected by many factors. However, an asset is represented by relatively few financial instruments, such as stocks and bonds. The financial market is far from complete. It is reasonable to expect that some derivative securities are created to better represent the values of the underlying assets. The convertible bond is such an example. For young and small firms not rated by a rating agency, it is difficult to issue straight bonds with a low yield. At the same time, they may not want to issue additional shares at current price level, for this will dilute their ownership. Usually, small firms are volatile, which is often considered an unfavorable feature of a firm. However, the design of the convertible bond turns this feature into a positive one. The call options are highly valued, since volatility is high for small firms. Because of the call option on equity, convertible bonds pay lower coupon than the straight bond. Since the convertible bond properly represent the features of young and small firms, they have become increasingly popular among these firms, especially among high-tech startups. Information related to convertible bonds. Information about a company could be reviewed from trading activities related to its convertible bonds. The following story is about China Travel convertible bonds. This is a graph of price and volume of trading of China Travel. Why trading volume is so high on some days? Some background information. Convertible bonds often have position option. The option can be exercised only after stock price are over the strike price for a certain period of time. This feature is designed to prevent manipulation of share prices. In the case of China Travel, to force the conversion of China Travel convertible bonds into common shares, the daily closing price of China Travel stock had to stay over 5.49 Hong Kong dollars call price, which was 150% of the conversion price, for more than 20 of 30 consecutive trading days. On August 6, 1997, the share price of China Travel went over the call price of Hong Kong dollar 5.49 for the first time. At that time, share prices of China Travel were higher than its convertible bond prices. This is theoretically impossible. This indicates strong buying of shares to push share prices up. The figure shows unusually high trading volume around that time, indicating strong market manipulation. However, the financial markets around Asia turned very bearish soon, and China Travel managed to support its share price over the call price for 19 days before it succumbed to the sharp fall of the general market. For all its effort, China Travel could not convert bond into equity. This failure of conversion of China Travel gave a clear sign of the trend reversal. According to the equity value of China Travel at the end of 1998, it would have made over $66 million profit if the conversion had been successful. Comparing with its operating profit of $17 million for the first half of 1998. A trader confirmed that he spotted the signal and used it in trading. Several traders in different firms told me that borrowing shares of China Travel at that time was very difficult, although they didn't understand why.